Have you ever heard of a BDC? They're an under the radar type of business that's getting a lot of traction in the income investing world. I recently wrote about the best high yielding dividend stocks to buy, and one of the companies that came up on the list was Trinity Capital. Trinity pays about a 12.5% dividend, and they're covered by multiple analysts that rate the stock a buy. So today, I'm excited to be sitting down with the CEO of Trinity Capital to explain what BDCs are, how they work, and why a company like Trinity could be that hidden gem in your investment portfolio. But before we proceed, I wanted to give a shout out to The Motley Fool for sponsoring this video. The Motley Fool provides investing insight and stock recommendations for investors of all types. So I'm thrilled to partner with the Motley Fool to bring you 10 stock picks from their stock advisor. The average stock pick inside Stock Advisor is up 863% versus 173% for the S&P 500. Scan this QR code or check the link in the description to get your 10 stock picks now. Okay, let's get started. All right, we are here with Kyle Brown. Kyle is the CEO of Trinity Capital. Thank you so much for joining me.
Thanks, Rick. Appreciate you having me.
Great. So, Kyle, I'm actually a shareholder of Trinity Capital, but I wanted to get your take on what is a business development company? Because Trinity is a BDC, and not many of us know what a BDC is. So, how about we just start there?
Yeah, so business development companies been around for 80 years or so. They have special tax treatment, so they're kind of like if you're more familiar with a REIT, real estate investment trust, very similar, but they invest in businesses, not real estate. So it's a pass-through entity. So an investor, when they buy into it, they're buying into a pool of assets, and these are typically loans. They could be equity as well, but primarily most BDCs are lending businesses. They're lending money to private companies primarily. And so the tax treatment's interesting because the business development company itself is not taxed. It's a pass-through. And so they're required annually to distribute 90+% of their income. So you're buying one of these vehicles to get into a diversified pool of assets, primarily loans to private companies. And because the BDC is required by law to distribute out its earnings, you're really buying it because you want income. And so each BDC is different. And then I'll get into it, but there's two different types of BDCs, externally managed and internally managed. And we can talk about that a little bit more. That's going to be one of our differentiators. But you're buying into it because it provides a really interesting diversification into private markets and primarily lending to institutionally and non-institutional backed private businesses in the U.S.
Interesting. And, many traders, many retail traders will typically invest in ETFs or perhaps dabble in stocks. How is investing in a BDC different?
So BDCs are generally, these are stagnant pool of assets. I'll start with externally managed, and then we can talk about internally managed. Most externally managed BDCs, which are going to be 90+% of the available BDCs out there that you can buy into. You have publicly traded BDCs and you have privately traded BDCs. The publicly traded BDCs, most of them are managed by a larger asset manager, and that asset manager is charging management fee and incentive fee for managing that pool of assets. They're a stagnant pool. They're typically, they're typically not growing, and they're part of an overall kind of greater thesis for that asset manager. They use those funds to co-invest alongside their larger investment thesis. Internally managed BDCs, we are one of just a handful of internally managed BDCs. We are also a large pool of assets. So when you buy Trin, and you said you're a shareholder, so you own a little piece of 100+ loans that we have directly lent to private institutionally backed companies, and it's generating a nice dividend and income for you. But you also own our management company. So there is not a separate management company out there that I own or someone else owns that's charging management fee and incentive fee. Our offering actually includes the management company. And so what shareholders get when they buy Trin or an internally managed BDC is they get that income stream from the loans that we issue directly to companies, but they also get ownership of the management company, which can do other things like manage private capital, charge management fees and incentive fees, and generate additional income above and beyond just loans that we issue. So you've seen Trend grow over the last, 5 years as a publicly traded company. You've also seen earnings grow and dividend growth, and that's a result of our corporate structure, which allows us to be consistent with the dividends that we're issuing to shareholders, but also grow the business as well. And investors can benefit from owning the management company as well. So two different types of BDCs. They come in different forms, and I'm preferential, obviously, towards a internal structure. I think the alignment with investors is really key. I own the same shares as you do, so you can rest assured that management and the company is thinking kind of similar things as you. We don't want dilution, right? We want to grow earnings. We want to see the business succeed because we all own the same exact shares.
That's really interesting. So it sounds to me like being an internally managed BDC that you're much more cost efficient or capital efficient than an externally managed.
That's one way of thinking about it. I mean, the other way of thinking about it is, most BDCs are a pool of assets that are just loans, and we are that plus an asset management company, and just just a little bit different.
So how does Trinity Capital make money?
So we provide a suite of offerings to growth-oriented businesses, and that's a late stage VC. So think like Kleiner Perkins and Andreessen Horowitz backed type companies. Later stage, so Series C, heading towards kind of pre-IPO into the lower middle market, private equity backed companies. And so we like to say growth oriented businesses. These are companies that are growing at a 10 to 40+% annual growth rate. They've been around for 5 to 10+ years. They've raised money from institutional equity investors, and to the tune of anywhere from 20 to $1 billion, 20 million to $1 billion of equity. They've proven out some technology over a long period of time. They have a moat around that technology, and they're disrupting a kind of older archaic type business. They have real enterprise value. In many cases, we do a lot of equipment financing. So when I say a suite of offerings, those types of businesses, because we're really diversified, we're in a lot of different industries. They require to have different needs. What we do a lot of is just senior secured term debt, which means we're first in line, right, in any kind of liquidation event. But we also do a lot of equipment financing, which is our roots. We've been doing equipment financing for 17 years. We will provide manufacturing, build out manufacturing lines for companies that are producing something, testing equipment, et cetera, that has real liquidity value. And typically that's non-specialized equipment. So, we're helping these companies build their valuation as they head towards an M&A or IPO, uh, or some type of liquidity event. And so our money is going to be a little bit less dilutive than raising equity, and we're coming in to finance kind of mission critical type infrastructure or equipment so that they can continue to build out the business. And we typically are in these deals from anywhere to 2 to 5 years, as they head towards kind of more bankable type financing, or again that kind of liquidity event. So it also comes in the form of ABL. We'll do receivable if depending on the type of receivable financing, and then we'll also do kind of add-on acquisitions for companies that are acquiring other businesses in the lower middle market. So I love that space. These companies are typically valued at $1 billion or less, so 500 million to $1 billion of enterprise value. And I love the space because we're writing checks from 20 to $100 million. It's less competitive, but the companies have real value. They're at scale, and we're able to get in there and help them really achieve those certain milestones as they head towards that next, liquidity event.
Yeah. I can see how that's quite exciting. What type of industries do you gravitate to any specific industry, or is it any pre-IPO sort of company that's interesting to you?
Yeah. So if you look at where private equity dollars and like kind of late stage venture dollars are flowing, we typically focus on that space. And so even today, and it's been this way for a long time, we do a lot of enterprise software. We really like those deals. They have long-term contracts with enterprise type accounts. So we still do a lot of software financing and tack-on acquisition for software companies. We will do some of the kind of frontier tech, some of the newer stuff you see. We do a lot of space tech. We call it frontier tech, but that business is heavy in CapEx, and so we're providing a lot of equipment financing. One of our largest holdings is Rocket Labs. They're competing against SpaceX for launching satellites into space. So we see a lot of activity in that area. The AI boom that's happening right now, and this is typical for us, we're not really taking a lot of risk on operating businesses in that space. I think that world will see kind of who the winners are and who the losers are. What we do and what we're doing in that and with AI right now is providing a lot of the picks and shovels type financing. So we're doing a lot of the financing of AMD and NVIDIA servers, power infrastructure for data centers. So we are actually pretty involved in the AI boom happening right now, but it's going to be a lot more on the equipment side with the equipment that has real value, whether or not that operating company is using it. And so we typically, if it's kind of a bleeding edge type technology like that, where the market's still trying to figure it out, we'll get it in ways where we can really limit our downside, but still participate in the upswing, if that makes sense.
That makes a lot of sense. So you were saying that a major part of the business is lending out money. How does interest rates? I mean, interest rates have been top of mind the last couple of years, more so than they have, perhaps since the financial crisis. How does that affect your business?
As most BDCs who have floating rates, and the majority of our loans are floating rates, we got to see some of the benefits of rate increases. I would tell you that the margins really didn't change too much. And they haven't. In the 17 years we've been doing this, they haven't evolved too much. And so as rates have come down, the one thing we did before rates started to increase was we created floor rates in the portfolio. Over 60% of our portfolio right now is at its floor rate. And so the idea of rates shifting down really won't impact our earnings potential too much, regardless of the rate decreases. And so we're insulated a little bit. Uh, Trinity is from kind of rate decreases, but in our world, the loan to value, unlike the upper middle market or middle market, our loan to value for our companies is relatively low. And so rate increases really didn't dramatically impact or hurt companies because the cost of debt and those monthly payments or quarterly payments, it wasn't too much of a burden on them. And so in our world, we did not see a lot of volatility or pain in the portfolio because of rate increases and that increase of cost of capital for these companies. Because unlike the upper middle market, these companies are less leveraged. They're lightly leveraged. It's a way for them to just complement the equity they've raised, and we just haven't seen a dramatic impact for our portfolio.
Okay, great. I've written about Trinity Capital in the past. I think most recently, back in February, it came up on a screen, on a stock screener, looking at analyst ratings and such. And congratulations, by the way. I mean, you have a lot of analysts who like the company, like the stock. What's next for Trinity Capital?
Well, so we have been, and this has been part of our plan ever since we became and consolidated. We were a fund manager, just like a lot of other finance companies. We consolidated all of our funds into this one business, Trinity, late 2019, early 2020. And the plan all along has been get to scale so that we can start to see some of the efficiencies of scale, reduction of costs, and then really start to leverage the internal structure, which gives us the ability to generate revenues above and beyond the loans that we issued. So you've started to see it in the earnings, a few cents every quarter. The goal is for it to dramatically increase over time, but we're out there raising. We have SEC approval to own a management company now, and we're out there raising private capital, investors who don't want access or who can't have access to the public markets. We're out there raising money now privately to co-invest alongside of the public company. 100% of the management fees and incentive fees that we charge there flow to shareholders. So this management company is 100% owned by the public company. And as we're successful raising capital, charging fees, what it does is it gives us the ability to not dilute shareholders, but continue to grow. And those management fees and incentive fees will flow through the management company, which will create NAV. It'll be NAV accretion. So we can actually increase the value of Trend and generate new management fees and earnings per share without issuing new shares at the public company. So this has been in the works for 24 months. And you've just now, the last couple quarters, started to see some of the benefits of it. And it's really kind of the massive kind of driver for growth of earnings and value for Trinity going forward. So I'm really excited about that. We have indicated to investors on some of our quarterly calls that we intend to close multiple funds this year to co-invest alongside the public company that the public company will manage. And that's all gravy and upside to investors. So that's something our shareholders should be excited about.
That definitely does sound exciting. It sounds to me like shareholder value is something that's important to you.
Yeah, I said at the beginning, but unlike all other BDCs, myself, our management team, and every one of our employees, we own the exact same stock as you do, Rick. And so it aligns our incentives, right? I do not want dilution. I want growth of earnings, right? And so we picked this structure. We saw the success Main Street had, even Hercules, and it's that alignment with investors. It drives great behaviors because most BDCs have little to no ownership from the groups that are managing them. And so you can tell with most BDCs, they're really just focused on AUM growth because that generates more management fees and incentive fees. We're completely flipped the other direction, which is we're really incentivized to build a business without diluting shareholders because we would just be diluting ourselves. So I think that alignment is something investors don't always understand. And when they do, they can really see that, hey, the growth that Trinity's focused on and the building that they're doing, this is all for the long term good of the business and shareholders. And so we want people thinking that way. That's how we actually think and how we operate and I think the last 5 years we've been able to prove that out.
Well, it's definitely obvious in both the return and the share price. Kyle, do you have anything else to add related to Trinity? I mean, we've talked for a little bit here, and I've got to say I'm very excited. But is there anything that I haven't covered?
As I've kind of alluded to here, the growth for us is, yes, being a consistent dividend. We're highly focused on earning the dividend and then increasing the dividend over time. But we are building an asset management business that has really limitless upside to it over time as we successfully generate new revenues through managed accounts. And so that's something that investors can just continue to keep an eye on with us. And we want shareholders to think about buying and holding for a long period of time and getting a great dividend and seeing the value increase. And that is very unique for BDC. But that's what we're trying to do.
Kyle, this has been a lot of fun. Thank you so much for joining me today, and I hope to chat with you soon.
Thanks, Rick. Appreciate you having me.
Bye now.